Coronavirus crisis is hitting every demographic in society with new fears and challenges. Americans in or nearing retirement may be facing some of the biggest hurdles. Are you taking the right steps right now to prepare for them? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services and also the brand ambassador for the Retirement Income Store. Obviously, there's still a lot more that we don't know about how this coronavirus crisis is going to play out. We don't know how long it's going to take to fully contain the disease. We don't know how many more people are going to become infected, nor do we know the ultimate toll this will take on our economy. However, we do know some things, especially that getting back to normal won't be as easy as flipping a switch. It'll be a slow, difficult process. As we discussed last week, we understand some things will have changed for the good. A new normal will emerge, a new corona economy, which is even taking shape now. Here's one more thing that we know. No matter who you are, virtually every aspect of your retirement plan is going to be impacted by the crisis, more than it already has been. Every day you're struggling with new questions like, can I still afford to retire when I want to? Will there be jobs available if I want or need to keep working? What does this mean for my tax strategy, my Social Security strategy, my estate plan? Even things like whether you still want to travel or take a cruise have become important questions. Here's the good news. If you're struggling with these questions now, it means you still have time to make changes and to modernize your retirement plan for the new corona economy. We'll talk about that on today's show and identify some more of the specific ways in which this crisis may affect your retirement, and not just financially. Joining me again this week for the discussion will be author, advisor, and co-host Jeff Small, along with my special guest, options trader and market analyst John Najarian, co-founder of MarketRebellion.com. And once again this week, we're giving you the opportunity to join the conversation. At any point, you can submit your own questions or comments on today's show or any financial planning issue via telephone message, text, or email. We'll respond to questions and comments live on the show. Before we bring in Jeff, let's do a quick recap on where things stand with the crisis in the economy and where they might be headed. A week ago, COVID-19 cases in the U.S. hit over 300,000 with 9,000 reported deaths. This past week, it went over 400,000 with 12,000 reported deaths. Odds are that number will take more of a jump in the future. I believe that if we're not careful, we could see upwards of 1 million or maybe even 2 million cases right here in the United States and many, many more deaths before we start flattening the curve. With that in mind, I hope all of you are stringently following the social distancing guidelines and taking every precaution that you can to help contain the spread of the disease. And I think this is crucial because the economic crisis triggered by this pandemic can't really be contained until after the health crisis has been contained itself. We cannot put the cart before the horse. And as we discussed on last week's show, actions taken by the Fed and by Congress in response to the crisis, I believe will do very little to stimulate the stalled economy, either now or after health restrictions are starting to get eased. They're really just relief measures meant to keep the banking system, the plumbing of the banking system, functioning to minimize the damage as much as possible. Odds are much more relief will be needed. As you know, unemployment claims have been skyrocketing by the millions every week. That number will eventually level off. But remember this, that weekly figure just covers new filers. So even if the weekly number of new claims starts to drop, remember that the cumulative number of people out of work will still be growing, and the number could be staggering. Among that number will be baby boomers, some possibly just a few years away from retirement, and some perhaps still working part-time as part of their retirement strategy. Obviously, that strategy has to change now. And that's just one example of the many new realities that boomers are facing in this new corona economy. Coming up, we'll talk about some other new realities for baby boomers and about what the crisis could mean if you still have significant assets in stocks or stock mutual funds. Now it's time to welcome my co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida, and also Amazon best-selling author of the book, Turning Financial Planning Right Side Up. So Jeff, let's talk about this. We have John Najarian coming on here in a couple minutes. We've got, 400,000 people currently infected here in the United States with this virus. Third week of record unemployment claims. What do you make of it all?
Well, I think right now we're seeing unbelievable numbers as the pandemic becomes global in nature, not just domestic, and it continues to accelerate and gain traction with no real peak in sight of the infection rate. And so I think, it's not just a domestic concern as much as it is a global concern, Dave, and it's going to reshape everything that we do in our lives because we don't know anything more than we did in January in reference to this virus. We have no idea what the half-life of it is or how long it's going to last.
Yeah, and it's interesting because the stock market this week, thankfully has been calm. It's been up compared to the last few weeks, as you know, and I'm looking at it though, and it doesn't make sense. I'm afraid a lot of it is because of the Federal Reserve saying, oh, we're going to buy corporate bonds, and then the Federal Reserve now coming out and saying maybe we'll buy less than investment grade corporate bonds. Yeah, I wouldn't be surprised, heck, if in 2 weeks the Federal Reserve comes out and says we're going to buy stocks to prop up the stock market, right? Have you thought about that?
Yeah, I'm pretty disturbed at what's happening with the distortions in market prices versus what's happening on Main Street America. When you factor in what the Fed is doing, I think you can just discount 2020, the revenues, the net earnings, whatever bad news, good news companies are going to have. It's all about the Fed propping up balance sheets at this time. Yeah. And so, as I've always said, Dave, and you've heard me say it before, their real job is what?
The Fed's real job?
The Fed's real job is to prop up asset prices. That's their number one objective.
It's not supposed to be their real job, but more and more I'm coming around to your way of thinking that you might have a very good point.
Well, everything that they're doing, all the financial engineering they're doing indicates that as they have plugged the bottom of the bond market because the bond market has not recovered yet. It hasn't even tried to recover, and that's the ultimate barometer for what's going to happen to the economy. And as we march down the line here 12, 24 months out, how many companies are not going to be able to weather the storm?
In fact, the fact that the stock market recovery has actually been a little faster than the bond market recovery, scares me. It scares me that there's animal spirits, a lot of animal spirits going on. A lot of people don't understand the full magnitude of this. It scares me that there seems to be maybe a lot of inside people trying to make short-term profits. And there's this bigger and bigger disconnect, if you will, over the last week or so between the economic impacts of the coronavirus versus what as of today seem to be the stock market impacts.
Well, as of right now, Dave, we're 28% off the lows from the bottom of this thing, and only 1/5 of the actual stocks are back up to break even. And so 80% of the market is lagging behind, which tells us there's a massive rotation into companies that have the best balance sheets. Yep. And that's really what's carrying the market right now, don't you think?
I do, and it's going to be interesting because it's a great question for us to ask John, because John is a stock guy. Last week we got to interview Muhammad Alarian, who's more of an economist. John, being a stock guy, it'd be interesting to ask him which sectors he thinks are going to do the best in this, because it's really more of a stock picker's market than it is a stock index buyer's market, correct?
Oh, there's no doubt about that. Even though the indexes are rising, I don't think you can go wrong buying indexes versus mutual funds at this time. But at some point, the market is going to capitulate, and stock prices will reflect their fair value because they are detached from fair value right now. Because 2020 and whatever economic destruction we're going to have as a result of the virus has completely been thrown out the window.
Yeah, and we've had. To think about what we've had over the last 2.5 or 3 weeks, we went from 100,000 infections to 400,000 in 2 to 3 weeks. I can't remember the exact time. Some of the projections for GDP shrinkage, our economy shrinkage in the second quarter have gotten worse. They've actually gone from, Goldman Sachs at minus 24% GDP in the second quarter to Morgan Stanley saying minus 38. Now firms have come out saying, we might have unemployment minus 30%. So that's again that disconnect between what the stock market's done this past week versus what in the real world we're seeing economically. The economic projections haven't gotten any better, right?
I could not agree with you more. The disconnect is awful. And the way I look at it, Dave, very quickly is 60% of the economy has virtually stopped moving. And if 60% of the economy has stopped and 70% of our GDP is consumerism, then I'm looking, and I hate to say this, for a 42% drop in GDP, not the 24% numbers or the 30% numbers that have came out from the major Wall Street firms. When this thing is all said and done and it shakes out correctly, and it's going to be brutal on the, it's going to be a brutal assault on our financial sense.
It could be, and if the president pulls us out of this quarantining, if you will, voluntary quarantining too soon, we might see a drop in the number of cases and see economic activity go back up. But then if it spikes up a second time, these things, they spike with a vengeance, just like cancer. You get cancer once, you get cured. If you get the same cancer the second time, it comes back with a vengeance. And that could very well happen here. So we could have a period of time in the summer where we think, hey, things are better, the economy's coming back, and then we get the second spike because we all went back to our lives too soon, and boom, now, we're stuck at home and going through this for 6 months. So that's my concern. But listen, Jeff, we need to take a commercial break here and then be anxious to get Mr. Najarian back on the line and to see what words of wisdom he has to say. So stay with us. We'll be right back here in a moment. Coming up on the Income Generation. We'll be right back.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
Depending upon your situation, the grim reality is this. The current pandemic and its economic consequences could potentially devastate your retirement goals and prospects. The good news, though, is you still have time to prevent that from happening. The even better news is that the crisis is changing the outdated attitudes that many boomers, many members of the income generation, had toward retirement planning and are opening their eyes to the importance of financial defense. In fact, if you're a regular viewer of the income generation, you know that financial defense, or as I call it, asset overprotection, is the very cornerstone of the income-based model. I talk about it all the time, and I've been talking about it these past 3 years, largely in anticipation of an event just like what we're seeing now. Remember, history tends to repeat itself more often than not. And while some aspects of this crisis are unprecedented, others are not. The extreme volatility we've seen in the market since the pandemic started is the same kind of market chaos we saw during the last two major corrections this century. Ultimately, those chaotic swings up and down gave way to a total market loss of nearly 50% in the first correction from 2000 to 2002, and nearly 60% in the second one from 2007 to 2009. Many of you who are retired or nearing retirement may have still been in your prime working years during one or even maybe both of those downturns. And some of you may have seen your 401ks and other accounts decimated, possibly twice. And hopefully not. Hopefully you took action after either the first or second downturn to reduce your market risk with the help of the right advisor. If not, then the main potential impact of this crisis on your retirement is obvious. You're a few years older now than you were then. You have a shorter time period. This time it could shrink your nest egg to a point where you may have to drastically alter and drastically minimize your retirement goals, or perhaps postpone retirement for a while. Remember, that's the reason financial defense is so important for those over the age of 50. See, once you reach that age, you've lost the luxury of time on your side to recover from a major loss. This wasn't true if you were in your 30s and 40s when the last two corrections occurred, but it's true now. While no one could say with absolute certainty that this is the start of a third major correction, at this point at least, I believe it seems more likely that it is. And if so, historical evidence suggests that we could be looking at total market losses of at least 55% and possibly as great as 80%. And that's why I believe one silver lining in this dark time is that it's opening more baby boomers' eyes to the importance of financial defense. Despite what you may have heard elsewhere, it's still not too late to take defensive action. We'll talk about that more later on in the show. Next, we'll look at some more ways the COVID-19 crisis hitting retirees and near retirees specifically. Now let's bring in my co-host, Jeff Small, and also to welcome to our show our good friend, John Najarian. John is an options trader, market analyst, and the co-founder of MarketRebellion.com. He's also author of the new book, Follow the Smart Money, along with his brother, Pete. John, thanks so much for being with us again on the show.
Thank you. Great to be with you guys, and great to meet Jeff as well.
Yeah, it's interesting, John, because we spoke right after Christmas was when you were on the show last, and of course, gosh, what a difference 3.5 months make. It's a totally different world right now. So I want to divide my questions first into two categories. First of all, the economy. What are your thoughts about how bad this is going to end up being economically during this time of what I call economic stoppage due to the coronavirus?
Yeah, well, that's one of those known unknowns, if you will, David and Jeff, because we know when we go to a screeching halt and consumers are locked inside their homes for the most part, at least 90% of the country, it seems like, is locked away somewhere, that's going to impact economic activity in a way that we've never seen. It's like a hurricane hit the whole country. It's like a flood hit the whole country. I mean, everything's flat.
I know. So let me switch gears to the stock market then, because we had Mohamed Al-Arian on last week, and of course he waxed poetic about the economy part of it, but you're a market guy. So what do you think about the market where we are today? Have we seen the worst? Are the bottoms in for the market? Or do you think we might be making more new lows, if you will, as more bad news eventually filters out?
I really don't think that we're going to see worse than we've seen already. Now, obviously, we could do a double dip on the virus itself. People, could come down with a second wave. But unless that second wave is bigger than this first wave, I think we've seen the worst. And we've never seen, I'm sure Mohammed agrees, we've never seen as much stimulus, both fiscal stimulus as well as the monetary, what the Fed is doing and what they've done is literally unprecedented, at least at the dollar levels, the $1 trillion levels that they're doing. So I think the markets are going to be reacting to that for years, actually, David. And I think the economy, especially because of the most recent Fed move, helping out small businesses and municipalities, I think that will help faster than the money from the Congress and the president.
Hey, John, Jeff here. Jerome Powell said today that the Fed can lend as much money as it wants under the law and what the law provides. Don't we run the risk of creating an environment where there's not going to be any growth in equities or any growth in the economy, if the Fed plans to use an open checkbook to unbail us from the lack of economic activity and the disruptions that are going to occur?
Yeah, Jeff, you're absolutely right. A lot of us worry about, okay, if we're doing bailouts, number one, how do you pick and choose the winners and losers? How do you pick who survives that lifeboat ethic, if you will? In other words, are you going to let some equities fail? Equities, of course, meaning stocks. Or do you look at some companies and say, well, sorry, shareholders, you're going to get massively diluted. And if you get massively diluted and you're a shareholder of a company that happens to, is it fair? Is it balanced? Who picked who gets bailed out and who didn't? So to your point, there's a lot of those questions.
Okay, so we're having technical difficulties here, everybody. We unfortunately, this whole working from home thing is great in concept, but it's not great in concept when the internet fails and Skype fails. So my apologies. I think we have you back. We have you back now, John. So you cut out partway through that. If you want to finish up, we've got a minute before a commercial break. Go ahead.
Okay. I don't like the idea of the government picking winners and losers. I didn't like it in 2008, Jeff, and I don't like it now. But I think it's likely that they will have to let some companies go. And to your point, that's going to inhibit growth because people won't want to invest in companies that they perceive as dead in the water, as equity that's just vaporized and only the bondholders get paid.
I couldn't agree with you more, John. Those are great points because Main Street is detached from Wall Street right now, at least as far as fair value goes in terms of what's going to happen. You're exactly right.
Yeah, it's crazy. We had this risk back in 2008 with the bailouts. Back then it was just financial institutions. As I said before, John, you didn't hear me, but before you came on, I was telling Jeff on the show, I said I thought that, before you know it might be 2 weeks and the Fed might come out with an announcement saying they're buying stocks, which will be really interesting. We need to take a commercial break. We'll be back in a minute. Stay with us. We'll be back with much more from Jeff Small, John Najarian, and yours truly right here on The Income Generation.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementinComeStore.com.
If you're a regular viewer, you know that I talk frequently on the show about the many social and financial challenges that are unique to our income generation. Even before this crisis, boomers faced many retirement issues that our parents and grandparents didn't. These things include longer lifespans, skyrocketing healthcare costs, the loss of traditional pension plans, along with challenges of being the so-called sandwich generation, with financial obligations toward both grown children and also possibly aging parents. Not surprisingly, many of these challenges will be or have already been enhanced by the coronavirus crisis. For example, baby boomers living longer means many are also working longer. Of the 72 million Americans born between 1946 and 1964, the majority are still working and plan to stay in the workforce longer. But for many, those plans may have to change as the new corona economy takes shape and millions face layoffs. Here's another example. Today, an estimated 1/5 of baby boomers provide elder care, either remotely or in person, to a parent or other family member. If you're one of them, you know your loved one is in the most vulnerable group. and you're probably stressed out to the max right now. Unfortunately, for those whose loved ones do get sick, that stress may also give way to new financial burdens. And what's more, many believe the current crisis might just result in permanent changes for nursing homes, senior housing, assisted living developments, changes that could impact your loved ones or you directly if any of those options factor into your own retirement plan. Permanent changes are also probably in store for the travel industry in this new corona economy. And that's huge when you consider travel is one of the #1 goals for a majority of retirees. In January, the AARP reported that baby boomers plan to spend an average of $7,800 on 4 to 5 trips in the year 2020. 51% said they were planning at least one international trip, and a third said they plan to take a cruise. How many of those trips will be permanently canceled now due to the fear or financial hardships? That remains to be seen. Some specialists believe it could be enough to significantly change or limit some travel options for retirees in the future. And these are just a few of the ways in which the new corona economy is and will continue to impact retirees and near retirees specifically. We'll touch on a few more and also tell you what you can do to modernize your own retirement plan to prepare for this new corona economy coming up in just a moment. Right now, let's bring back my co-host, Jeff Small, and our good friend, John Najarian, options trader, market analyst, co-founder of MarketRebellion.com, and also author of the new book, Follow the Smart Money. Jeff?
So, John, to build on what we were discussing earlier, we're entering this new corona economy is what we've kind of coined it now because our lives are going to be completely different economically than what they were prior to this until we get a vaccine or a therapeutic that's 95% effective. What stocks or sectors do you see leading as we transition through this COVID-19 coronavirus economy? What do you think is going to be the sweet spot, the silver lining here, if there is any in this environment at this time in the markets?
Great question, Jeff. And I think a lot of it depends on exactly how much further some of the consumer discretionary plays go. I mean, we've seen how they react and how quickly they react, Jeff. For instance, the cruise lines. I thought that it would take Warren Buffett or Blackstone, BlackRock, one of those big, gigantic firms to commit billions of dollars to these guys. But instead, we got the Saudi Sovereign Wealth Fund that came in. And that sort of thing is what I'm looking for. I think we'll see retailers, consumer discretionary area that is literally flat right now, as flat as it could be, whether it's airlines, cruises, a lot of the department stores that are deemed non-essential. I think those, Jeff, are going to make massive jumps, but I think you're going to have to be selective because of the possibility that a number of them are going to experience, sort of that light, that blinding white light that says maybe they're not going to survive.
Yeah, I think that's the $69 million question right now. So additionally, though, besides all of that stuff, I know options are your wheelhouse. I've read your book. I watch you on CNBC discuss these things all the time. Are there any covered call strategies or any gauges you use to measure option inflows and sentiment in the market that you'd like to share with our viewership at this time? If we can just keep it a little simple, though. So what would you like to tell us there, John?
Well, so right now, we talked a little bit about how when the entire markets shut down, it's very similar to a hurricane hitting the entire country. So I think that premium that the insurance company would get is exactly what you and I know, Jeff, is happening in options. The options premiums are sky high right now. Even though they've come down a little, they're still sky high. So writing those options against the stocks that you own has never been a better strategy than right now.
That's great. John, I want to bring it to our viewers because, our viewers are mostly doing a lot of conservative investors, a lot of investing for income, thus the term income generation. But a lot of them still want to be in the game. I've had one of my clients who's in his mid-80s who's literally called me 3 times this week because he's trying to figure out how he can be in the game and be a capitalist, if you will, and be opportunistic with some small portion of his money. So since you guys are so smart and so good with that stuff, I confess, I'm sorry, I'm going to read it this weekend. I have not read your new book quite yet, but I am going to. But I want to give you a chance to talk about what is in that book and what our viewers can get from that for the portion of their money that they really do want to use to become capitalists.
Well, and thank you very much for that, David. What you can get out of it, folks, is that you don't have to have that full commitment to stocks. You don't have to be investing in Apple at $265 a share and buying 1,000 shares of that as a new condominium. If you have that, that's great. If you don't, I can show you plenty of ways you could invest and control that stock for less than $10,000. It's all about timing, and then it's about understanding time decay and how options work. You and Jeff are experts at that, but I think it is definitely something that investors should be looking into right now, especially during the time when you're at home with extra time on your hands. What better thing than to, for those that don't already have that skill.
Yeah, I guess if you're trying to be in the game with a little bit of your money, the options do give you the most leverage. So we only have 1 minute left, but I know a lot of people will read the book, they'll be do-it-yourselfers, they'll get into it, but then correct me if I'm wrong, but for those who read the book, learn enough about it, but still want some additional hand-holding, you have other services also that you provide, if I'm correct, to help those individuals. True?
We do, and I'd encourage you to come on over to Market Rebellion, folks. If you put in income generation, I'm sure we can get to a special deal. We have mentors, we have online classes. So thank you for mentioning it, Dave. And again, if they put in income generation as a promo code, I'm sure we can help them out.
Well, let's plan on doing that. You know, it's funny because in times like this, people realize, maybe for the first time, how risk averse they are or are not. And some people are realizing they're totally risk averse, they don't want to take any risk, and others are realizing, wait a minute, I want to be a capitalist with a little part of my money. So with that in mind, John, thanks so much for being back with us here on The Income Generation. We appreciate it.
Thanks, Jeff. Thanks, David.
You stay with it too.
Take care.
We have more coming up here in just a moment, right here on The Income Generation. We'll be right back. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more. In addition to the checks sent to individual workers, loans to small businesses, and other steps, the coronavirus relief package approved by Congress also included some provisions for retirees. One was to essentially suspend required minimum distributions for the year 2020 across the board. This change has prompted a lot of questions about what it means for those who already took their distributions and the impact on taxes and inherited accounts. As always, the answers to those questions are likely to be different for every individual, depending upon your specific situation and your retirement goals. And as we've been discussing today, that situation may be changing now, and those goals may have to be adjusted thanks to this new corona economy. More than ever before, I believe finding the right financial advisor to help you with those changes and adjustments is critical. Whether it's revisiting your tax strategy, modifying your estate plan, or making sure your asset allocation is still right for RMDs or right for your Social Security option that you decide to take. More urgently, reducing your stock market risk to prepare for the potential of this being another major market correction is paramount. Why? Because this correction could possibly be in the range of 55 to 80%, according to the hard lessons of stock market history. You may have heard brokers or other advisors argue that it's already too late to make that move, that if you pull out now, you'll lock in your losses. Well, I disagree. I say that if you believe history is like to repeat itself and will hit that bottom point, you still have time to act to help protect your investments from additional losses. What's more, since there's no law that says you can't get back into the market at a lower point, you certainly have the option to do that. You can buy in again at the bottom, and you're not going to find the exact bottom, but you can buy back in at a lower point and ride the next long-term secular bull market cycle back to the top. And the right advisor can help you implement that strategy. At the same time, you'll have modernized your portfolio and overall retirement plan for the new Corona economy and greatly reduce at least one source of stress in this extremely stressful time. Now let's welcome back my co-host, Jeff Small. So Jeff, what do you make of John's comments during our interview?
Well, I think John was really in tune with what we always have been saying, Dave, and that the financial universe is going to be a lot different now. We could potentially retest the lows or at least get other buying opportunities, but for now the market's bullish only because of the Fed, and it's disconnected from what Main Street is really happening with almost 16 million jobs lost. We're going to have a lot more of jobs lost, and with 90% of people having to stay home now, we're going to have a hard time for asset prices to increase. So 2020 is right out the window. It's all about what the Fed is doing.
Yeah, I agree that long term we get through this, which could be 2-3 years. We might see new record highs because all this cheap money that's flooding the economy. And we know, just like the last time the Fed did this, right? The money didn't go to create inflation, to buy goods and services. Most of the money went into assets, created asset inflation, which is why the stock market went nuts for a whole bunch of years after the financial crisis. But nonetheless, where I disagreed is I think it's going to get, and you think, I know, it's going to get a lot worse before it gets better. And what I hate to do is I hate to see people take all that pain if they don't have to.
Well, you're exactly right. At some point, asset prices will reflect what's happening in the economy, even though they're not reflecting that today. But eventually, they will reflect what's happening in the economy, and they will adjust. And at some point, like you said earlier in the show, what's the Fed going to do? Buy stocks? At some point, they may have to plug the hole to prevent values from declining even further.
In a fundamentally sound market, all that cheap money can really create record highs and create a bubble, sure. But when we're starting to talk about a recession, that the only thing we know of that maybe even rivaled it was the Great Depression, I don't see that cheap money doing that. I want to switch gears with you, Jeff. I want to talk about that. Remember, off the air, you as our viewers didn't get to see this, but John was talking about how right now, that condo analogy he made, he's able to control essentially $250,000 of dollars of a particular stock, let's say, and by taking income by a strategy he talks about in his book called Writing Covered Calls, he's actually getting $15,000 a month of income right now because of the volatility. So as he told us, Jeff, he said, gosh, I'd have to have $1 million condo or more to get that kind of income, and now I'm doing it now by leveraging very little. The stuff that's in his book, what do you think of that strategy for some of our viewers with a small portion of their money?
Well, I think that's a good strategy. It's obviously it's a strategy that you're going to win no matter what the market does, as long as you're getting paid. So that makes a lot of sense. But it is also somewhat synonymous to our income strategies, Dave, where we use fixed income assets to create income. Not at that rate, but at least it's creating income in general, which I think the I is better than the G at this time.
That's what I love, because most options guys, you hear them talk, and they're talking about options, using them speculatively. He's not. He's talking about using them more conservatively, using them to generate income for the person that holds it. Just a different way to do what you and I do. So we need to go to break again. Stay with us. We have more coming up here. Jeff Small, David Scranton, coming up in just a moment on the Income Generation. Welcome back to the Income Generation. I'm David Scranton. I'm here with co-host Jeff Small. So, Jeff, I've had some strange things happen in the last couple of weeks. I had a client call me up out of the blue, a client that I've been pushing to get his estate plan done in the last, I want to say 2 or 3 years. And he always fought me, kind of the immortality, if you will. And he called me up, and now he's in a hurry to get it done. Now, the problem is our attorneys now aren't even in the office. We can't even get the thing executed if we get it drawn up. But it's all because he hears about people dying from this virus. And all of a sudden, he's starting to finally feel his mortality and wants to do it. Are you seeing behavior changes like this with your clients, too, that you talk to day in and day out?
We're seeing a lot of behavior like that, Dave, and a lot of people want to figure out how can they do that from home. So now we're using a lot of DocuSign type stuff, and we're doing online meetings, and people are going to transition. But what I'm also seeing is a pretty big demand for folks who are leaving the workforce now because they're afraid of getting sick, or they're getting ready to retire, or they've already retired and they're deferring on Social Security, that now want to collect Social Security and revisit with advisors how to maximize their Social Security and combine that with their other resources to create a retirement income. I mean, we're seeing that on our end. I hope you're probably seeing it too.
Yeah, and I've told somebody that, who had gotten laid off and was worried about actually saying, I want to take it now at 63 because I can't wait till 70 like we planned. And I said, that's fine, but this may be all the more reason now why you may need the higher benefit. So we looked at the portfolio, and in this case, they have enough conservative investments that, God forbid, if they can't get back to work again and they're forced to retire early, they can spend some of that money down over the next 7 years. And he doesn't necessarily have to start taking Social Security right away. So again, I just want to urge our viewers not to make a knee-jerk reaction. That's the time to come talk to your advisor, someone who's versed in Social Security, and get the answer. But on the estate side, gosh, Jeff, I had somebody this week too who last week who's concerned about the estate side because they said, look, my person who was my power of attorney for health care was a friend who's no longer living. Because my daughter was a minor, now my daughter's an RN, I want her to have the power of attorney. So now he's in a hurry to get that done.
Yeah, everybody's in a hurry to button up their plans, and that, and they feel like now that they can't go to somebody's office to get that done, they can. But what they have to do is they can still get it done from home. Fortunately, we have the ability to do that now, and that's going to be the new consumer dynamic, Dave. Everyone's going to be conducting business from home over the computer.
The problem is in the legal industry, they haven't kept up with it for legal documents because they've got to be witnessed and everything else. So hopefully we can get the legal world over on this side with DocuSign and things like that a lot quicker so this stuff could move more smoothly. Good thing, at least on the tax side, we're fortunate that the tax deadlines got pushed back, so they help out our viewers there. So that's it for this segment, everybody. We need to take a commercial break once again. We'll be back in just a moment, coming up right here on the Income Generation. We'll be right back. I'd like to thank our guests for joining us for another episode of the Income Generation. I'd also like to thank you, our new and returning viewers. If you're a regular viewer, I frequently share images like this, showing the kind of close personal attention an advisor who specializes in income typically gives his clients. Well, as this crisis wears on, we're discovering that being close and staying connected doesn't have to mean being physically right next to each other. In the new Corona economy, friends and family members are interacting more now than in a long time, online, by the phone, and businesses are doing it as well. Many of these businesses are discovering that it's possible to maintain or even improve upon every aspect of their business with this new model, including customer service. I mention this because even before the Corona crisis, many forward-thinking companies were already trending toward more digitally based business models, pioneering the approach and proving that personal service and individual attention could still be one of their highest priorities. The Corona crisis has turbocharged this trend. Thanks to social distancing rules, more businesses than ever are becoming comfortable with the digital approach, and even more importantly, so are their customers and potential customers. Now, as you may know, my retirement income store was also created in recognition of this cultural shift. Now that the Corona economy has kicked that shift into high gear, I'm excited about the opportunities that it creates for financial advisors aligned with the store and for everyday investors like you nationwide. As we saw today, this crisis is creating a host of unique new challenges for Americans in or near retirement, starting with those who may still be carrying too much stock market risk. Understanding and addressing these challenges is as easy as picking up the phone and finding a financial advisor in your area who specializes in retirement income and helping you protect your assets. And it's not too late, and it may be a great way to dramatically reduce at least one source of stress in these highly uncertain times. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton with Jeff Small, and we will see you next week.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.